Has the market changed its mind about what the Fed may do next?
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't.
Think of that number, and maybe more importantly, what do you think the Fed's going to do, and therefore what your equity is going to do?
I've been saying over and over again to my colleagues here that he wants your portfolio down so that you won't be able to spend as much.
Welcome back to Financial Stockholm. Today I have with me André Havas, the CEO of CIMalgo Analytics. And CIMalgo is a program that André can tell you a little bit more about after we introduce him. And this will be a discussion in general about the market. So with that, André, great to see you. Thank you. And if you want to go ahead with a quick introduction, and we'll start our discussions.
Thank you very much, Chris. I'm happy to be on the show again. And just to remind people, CIMalgo is a software developer. We develop software for financial professionals and people with a vested interest in capital markets and asset allocation. And the solutions are purposed for the ease and functionality, and also a workflow in order to generate, create, simulate robust portfolios of liquid assets.
Okay, excellent. Thank you, André. So today we're going to talk about the market, and I'm of course very biased and have a negative outlook, and I'm looking at a lot of different fundamentals to say, okay, what's going to make the market grow? But that can lead me into a bias trap where I could miss all the good opportunities. And that's one of the points we're going to touch on, and André can explain. Do you want to add anything about bias right now, André, or should we keep talking?
I think bias is just human. It's a human way of behaving. So everybody's biased in some way or the other. But where that bias stems from is very, very personal, and it can also be affected and colored by so many other factors. So to answer your question, bias exists. Bias can be alleviated, and it can be cured.
Exactly. That's a great point. It can be cured. And the point is not to fall into the traps of bias. So we have the market, we have the earnings, and starting with the earnings and possible future potential lack of earnings, we also have the banks. So we've seen the banks across the world, with really one exception, raising interest rates. And this creates a lot of fear because the risk premia goes up. And so your valuation for how you're going to invest and what you can expect for a return changes from what it was when you had a 0 interest rate or 1 percentage point interest rate to potentially a 2 or to a 4 or to a 6. And you have the comments from these central banks giving you the indicators that they're going to use, such as inflation and inflation targets, and those targets being around 2% in general, whereas here in Sweden, we've seen 11% in inflation. In countries like France, you only see a 6.4. In Germany, you're seeing closer to the 10 as well. And so you could correlate this to the increased cost of energy and the food cost. So it changes the view for the market, and it makes it interesting to see how companies will be able to continue to earn. The investor is looking at the market, following the volatility, and trying to make assessments to say, is this a falling kitchen knife, or is this one of these great bounce back opportunities of a fallen angel? And so ultimately, they're either going to do this, employ the strategy themselves, or pay for the advice from an advisor. And I think that maybe gives a good segue to let you talk a little bit about that, André.
To talk about basically the fear in the market and how it affects financial decisions, and also ultimately the advice that people would be subject to. I think that's a great question in itself. And I think some of the advice that people in normal would be subject to during a period of fear, or where when markets are jittery, is always a little bit lagging already. So it's a piece of advice that which seeks to alleviate some of the damage that is already done. So I'm not a stock picking guy as such, so you alluded to companies in particular, so I wouldn't make any judgments on particular companies in specifics. Although I'm an asset allocation guy, so I would probably look at companies as an aggregate of the economy through which you get exposure by buying stocks. So either an indice or an ETF or an actively managed fund. So I think if you break down those three instruments, so if you start with an index, it's just an aggregation of the market where somebody has applied a methodology by which you would always be exposed to a certain segment of the market. So the most common index is the MSCI World, obviously, so you will get exposed to 1,600 companies in the world, and that's also the one that everybody's trying to beat. So if you have a benchmark that is already super well diversified, you already know from the get-go that beating that index through stock selection is going to be a very cumbersome task in the long run. So putting that into context of jittery markets, a couple of years ago, the MSCI index was hard to beat because it was so heavily exposed to some of the technology companies. So that was basically the index driver. And now the opposite is happening, where the technology companies are basically the ones that are conducive to the relatively poor performance of the MSCI World. So no matter what you did during that time, you couldn't beat the index, neither on the upside nor on the downside. So I think what else is there to do if you want to beat the market? And I can give you a little story which I think is very interesting. It's not a story, it's actually the truth. If you would look at the S&P 500, so if you would have wanted to beat the S&P 500 through time, from I think the beginning of the 20th century, it would have taken you just 3 trades to do that. So basically, you go out of markets just before the crash during the Big Depression. Then you enter the markets. Then you go out of the markets. I think it was in the 60s, and then you enter the markets again. And then, if you could avoid the dot-com bubble, you will go out of the markets and then into the markets just after the dot-com bubble has subsided. So those 3 trades would have basically given you an outperformance relative to the S&P 500 by the double, I think. So my point here is basically, if you want to beat the market, you should look at it in 2 ways. So basically, one, in a risk-adjusted way, and also through asset allocation. So you have to define what is your personal benchmark, how comfortable can you be with a risk level, and then put it into the context of the potential return that you would be able to get from that risk level. And you know, the common notion around, among the advisory community is that if you take risk, that would lead you to greater returns. I think there's a little bit of an oxymoron attached to that to that saying, because if you take on risk, you take on something which doesn't have a necessary predictable return. So basically, you're buying something which you don't know anything about. Then there's another level of risk which we are experiencing today, which is volatility. So volatility can come from various factors in the world, and today I think that volatility is also a function of the world markets, investors not really knowing where we are heading. Thus, you are very biased, and you are also subject to a herd mentality, where basically everybody's going in one direction one day and the other direction the other day, until we get some clarity and another trajectory that we can assess for future investments.
Yeah. And I think you're right, and I think this kind of brings you back to your first point. Many investors are looking for that trick. What do? Do I go in and out at the right time? Can I trigger can I find the right time? Or do I just buy Amazon? Do I buy Google? Do I buy Microsoft and just own those three? Or, should I buy just an oil company? Or, so there are many tricks to beating the market. And that's what leads a lot of people to follow the bias or follow the herd. And so, as you said, setting up a balanced portfolio, having allocation to different asset classes is really critical, right? I mean, you need to have a few different things going in order to see production at different times from different sources, kind of like winter, summer, spring, and fall. Things will happen at different times, and you'll benefit from them. So that brings us to owning, say, the investor is going to look at this and say, okay, I'm going to diversify my assets, or am I going to trust somebody to do it? Or am I just going to buy a balanced fund, which is ultimately trusting their tricks to beat the market? And is there a way to kind of maybe scientifically follow this, or mathematically? And maybe you could talk a little bit about that with CIMalgo's approach.
Yeah, no, definitely. And once again, Chris, we don't give advice. We're a software development company. With that said, we do offer the tools and the functionalities in order to manage to build balanced portfolios using ETFs, using stocks, and diversifying across many asset classes. So I think the first way of doing this is to select the asset classes that would fit your investment purpose today and going forward. And I think the way of doing this is also to have a very clear view of how you want to position yourselves during this time and maybe for a foreseeable future, but also be ready to take some sort of activity if markets and sentiment and the overall economy would change. So I think 60-40 portfolio is a very good beginning. So if you can divide the world into 60-40 or 40-60 or whatever you want to percentage you want to have, it's a good way to start. But if we look back at the last couple of 15 years, that 60-40 portfolio did not really work because we had decreasing interest rates, which basically deteriorated the fixed income part of the portfolio. And then on the other hand, also we had rallying the stock market. So the 60-40 portfolio was a little bit off balance itself. So if people had held a 60-40 portfolio during the recovery period after the financial crisis, you would probably not have fared too well. Now, the other side of it is also to be very active in your 60-40 portfolio, in the sense that you need to have some sort of a dynamic trigger in order to allocate more to one asset than the 60 and less to one asset if that's the 40. So you need to have some signals incorporated and also some tools by which you can optimize your views for your future allocation. So that is also something that we provide our investors with. But at the end of the day, I think the way people should look at the 60-40 portfolio is basically in an industrial kind of way. So you basically build it as a company. You will have silos, and in each silo you will have a different payout structure. So you should see all of the underlying components of your portfolio as streams of cash flow. And you mentioned it yourself, Chris. You made an allusion to seasonality in terms of winter, spring, summer, and the fall. So every farmer would know when to plant the seeds and when to harvest. That it doesn't happen all at the same time. The only thing you do want to avoid is for the crop to rot. And I think that's also a very important thing to keep in mind when you're managing a balanced portfolio, either through an advisory relationship or if you do it yourself, is to always also not be, if you like, fooled by the fact that something looks good from a mathematical point of view, i.e. it gives you a higher decorrelation in your portfolio, but you need to also dig down into the intricacies of each and every asset class or instrument that you have allocated to, in order not to keep dead weight in your portfolio that would never do anything good for you in the long run.
I think that's great, and I agree with you. With the starting point for the individual is to make the risk assessment, and then to make their decision on the advice, and going to a professional who would have their risk analysis, and then enter into a investing strategy for them. I think it's very good that you point that out, and I like the idea of the harvesting, and you're running your multiple cash streams to provide you with your returns, to give you the performance in your portfolio that you want. And if you're looking to beat the index, or if you're looking to do as well as the index, or if you're looking to return better than the index, based on an absolute basis, or what your total performance is, it's very complicated, and very few individuals can actually make these assessments in a professional way. And so I think with that, obviously your product is with professional investment firms, and is there any place they can turn to, or what's the best way to go about this?
Well, they could always turn to us, and we could point them in the direction where they could find somebody who uses our product. But at the end of the day, I think the most important takeaway from this is that investors should be aware that portfolio management is not a simplistic trade where you just divide the world in one or two or three slices of a cake. It takes a little bit more than that. And when you are diving into the notion of balanced portfolio investing, it becomes even harder, because at the end of the day, if you only have stocks in your portfolio through a variety of funds, you will probably see that you will have the same movement regardless of which funds you have chosen. So the minute you add something else to the mix, that's when things can become very, very different. And that's the difference that you should be looking for. Short term, it can look a little bit disappointing, but if you get the mix right, you get the advisory relationship right, and you can also have a discussion with somebody who has a view on markets and also has a view on how to put the whole package together and also manage it dynamically. That's when you're in a good seat for future good returns. You will not always beat the benchmark in the interpretation of the word as a MSCI world. That's very hard to beat, but you should also set a benchmark for yourself, and that benchmark can be a composite of asset classes. So you can just put together a equally weighted benchmark comprising of real estate, private equity, commodities, and so forth. And that could be your benchmark. And now you want to beat that benchmark. So how can you beat that benchmark? I mean, there are a couple of ways of doing it, but you can either just find better components in the same category that could beat their reference, or you will do it through activity. And I think activity is probably the better way of doing it. But then if you're not equipped to do it yourself, or you don't have the nerves or the guts, you should turn to somebody who can do it for you. And there are a couple of questions you should probably ask that person or that firm. And it will very easily crystallize also whether they're equipped or not. But if somebody would come with an advice and tell everybody, look, now in these uncertain times, you need to be balanced. So I'm going to give you 50 equities, 50 fixed income. I don't think that's the way. It needs to be backed up by a plan as well. And that plan involves some sort of a dynamic overlay to your whole balanced portfolio. The other way of setting a benchmark for a balanced portfolio is just to apply a dollar value based on your notional investment that you want to achieve each year. So that's another way of looking at how to benchmark your underlying portfolio against the desired dollar yield, if you like, that you want to accumulate over a certain period of time. And that would probably lead you to a different way of looking at a balanced portfolio, where you would probably look at more yielding securities and so forth. So it's science, Chris. It's not easy at all. But with the right tools, technology, and there are so many smart people out there as well who knows how to deal with this. I think there's probably some very good opportunities for people to take advantage of those. But you should also be very careful not to fall in the trap where you're just being subject to an advice that is trying to fix something that has already happened. And you know, I come across a lot of people in my day-to-day life, and something that I still hear is how people are building portfolios in order to avoid the financial crisis of 2008.
Yeah.
You know,
yeah. There are no magic beans.
I think that's funny how you want to build something in order to avoid something that happened almost 20 years ago.
Yeah, I think that's a very good point. There are no magic beans, and you have to be clear in your targets, and then if you're one of those intrepid souls who feels they have the intellect and the programs available, sure. But I mean, that's where, if you're turning to somebody who's using CIMalgo, who would have the filters available to them and the understanding of what it is you want to achieve, they would be able to apply those filters and then give you the returns based on what they're projecting. You know, they may or may not make that projection, but you have a better chance at it, and it's through calculated odds.
Yeah, that's absolutely true.
Great. Okay. Well, hopefully this gives people enough of a feeling and an understanding, and of course they can turn to you and find out more and understand more about it, and turn to their investor advisors for this service.
Definitely.
Excellent. Okay. Well, thank you very much, Andre. Is there anything else you want to add?
Thank you, Chris. No, it's I'm always happy to chat to you on your show, and this topic is an important one. And I think, especially in times like these, where maybe some investors are taking some hasty decisions that might be unnecessary. So I think also that is part of the whole balanced portfolio dynamic, is that you can sometimes be a little bit hasty, and that would basically add to a higher friction cost than by just doing nothing. So, but that's another aspect of the whole exercise.
Yeah. One of our founding fathers in the US was Ben Franklin, and he said haste makes waste. And one of those key phrases we use here in Sweden is slow is smooth, smooth is fast.
Yeah, or to recite David Cameron, too many tweets makes a twat.
That's probably a better way to go in today's modern age. So, well, thank you very much, Andre. And we'll talk to you again soon, because I'm sure the volatility is far from gone, and we'll need some calming nerves.
Definitely.
Thank you, Andre.
Thank you.